Hello, good afternoon. Welcome to the investor call for this afternoon to discuss the first half results. So we have on the line EFG, Blakeney, Exotic, Jewett Group, and Swan Securities. And around the room here from the SBM team, we have Andrew Bainbridge, the Group Chief Executive. We have Raj Desoi, who is Chief Executive for SBM Bank Mauritius. We have Chris Lachminarayalu, Chief Executive for the SBM non-bank financial cluster. We have Ram, who is the interim CFO. Rita from the performance management team, Kumar from the IR team, and myself, Shailen, head of strategy. So I suppose you have all received the presentation that Kumar had sent to you earlier. And what we'll do, Andrew will do a short brief of the situation, and then we'll open up for questions. So please, if you have questions, you can send a mail to Kumar, as he stated earlier, and we will take then the names one by one. Even if you send a blank email, we will rank you accordingly. So, Andrew.
Fair enough. Shailen, thank you. And good afternoon, everyone. Thank you for making some time. I just wanted to run through the deck we ran through with the analysts in Mauritius earlier. It's no more than about a 10-minute presentation, then we'll open for questions and discussion. We did a proper analyst meeting earlier this year following the presentation of the full year results. But we thought it was appropriate to do an interim one in view of the impairment story at this half year, and obviously to give you the background to that as we go through.
Sorry to interrupt, Andrew. I just want to inform you that this call is going to be recorded.
Okay.
And we'll have a copy of the recording afterwards.
Very good. Thank you. So I'm just going to run through the presentation. I hope you have it in front of you. I won't read it out to you because that would be very boring. But assets continue to rise year on year quite significantly. Deposits continue to rise as well, and we'll talk a little bit more about that later on and decompose that. Net loans and advances also up. Liabilities up. Shareholders' equity down through two major components. The first is an IFRS 9 adjustment, and the second one is obviously the payout of the dividend compared to the profitability. The capital adequacy ratio rising to a healthy 23.94% overall for the group as at the 30th of June, and we will come back and decompose that later as well. Going into the key financial highlights. Net interest income up by 21% year on year. Non-interest income down by 0.6%, so pretty much flat year on year, and that's despite some slow markets and elements of our treasury business, but also a change in accounting regarding the gain on sale of securities that no longer goes through P&L but goes through OCI. So those numbers look worse than they actually are. Operating income as a consequence up by 14% to just over 4 billion for the first time. And then profit after tax down to a very disappointing 156 million rupees for the half year from 1.3 last time. I do want to stress that the pre-impairment profit increased by 5.4%. Obviously profit after tax, profit after that impairment charge. Not where we want it to be, not where we would deem it to be acceptable to be going forward. So, if we decompose the year-on-year walk for the impairment charge, which is page 9 of the presentation, take the 1.3 billion of last year, you add on the net interest income of 485, you're flat on non-interest income, but as I say, that hides an accounting change that moves against us. You've got growth in non-interest expenses, and we will come back to that a bit later as well. And then you've got the specific provision and write-offs, for which there are three real components. There's the suspected fraud relating to a segment B client. There is the increase in impairment on international operations, and there is a movement related to IFRS 9 during the period. And that takes you, despite a minimal increase in tax, to a PAT of 156.
Hello, do we have someone joining in?
No, I think may have put us on hold.
Yeah.
Whatever. So if we go to slide 10, deposit growth has maintained momentum. We have the counterintuitive position that deposits have continued to grow across demand, savings and term, up to a healthy 152.8 billion, up just under 50% over the last 2 years. And you'll see COD underneath each of the pie charts, it's cost of deposit. So in a rising US dollar interest rate environment, and as my colleague Raj Desai would say, rising volumes of dollar deposits with SBM, we're seeing a decline in the cost of deposits, which is very healthy.
Yes.
So moving on to operating costs, increased by 24% due to capacity building and the inclusion of SBM Kenya for full 6 months. Last year, SBM Kenya was included for only 6 weeks due to the date of acquisition. This year, it's included for the full 6 months. Capacity building initiatives are 2 things, really. They're about bringing some more talent and It's about bringing some more talent into the organization, but it's also about making sure we pay people properly and retaining that talent. So that's quite important. We go on to slide 12, and the gross impaired ratio and net impaired ratio both improved compared to this time last year. Now we're flattered a bit there because we did take a write-off in December. That means that the figures look better than they would otherwise do. Take the capital adequacy ratio, and we promised to come back to this. So the overall capital adequacy has improved year on year from just under 22% to just under 24%. We undertook a Tier 2 issuance in the first half. But what I would highlight, I think, to people is that you see the Tier 1 ratio going from 18.77 2 years ago to 19.26 to 18.97. So pretty much stable around the 18 to 19 range, well above regulatory requirements. And we feel very comfortable with Tier 1 at that level, and we feel very comfortable with adequate overall capitalization in the mid-20s. So those are the kind of financial highlights. We will come back in Q&A to it's important. Let's talk about strategy, and we've talked a bit about wanting to be a bank that does the Asia-Africa corridor, but also talk a bit about being a very strong franchise in Mauritius. So maybe with my colleagues Raj and then Chris, I could hand over to Raj to talk a little bit about Mauritius in terms of banking, and Chris in terms of MBFC.
Yeah, thank you, Andrew. I hope everybody's getting me clearly. In terms of the Mauritius operation, we continue to have a strong domestic franchise. In the retail banking segment, our market share is as high as above 30%. In the corporate segment, domestic, we have a strong market share which is above 20 to 22%. In terms of channel management, we are pursuing our digitalization strategy and migration to lower cost channels. We are rejuvenating our channels. We are redoing our branches. We are bringing in changing our POS. We are changing our ATMs, and this is an ongoing exercise for the next couple of years. We also bringing new products which are being launched either in Q2 or Q3 or Q4, all related to channel migration. Third point is we are also leveraging on our group entities for cross-selling. So we are working on more synergy between non-bank, for example, and the bank, between Mauritius Bank and Kenya Bank, between Mauritius Bank, India, so between Mauritius Bank and Madagascar, for example, for creating synergies and leveraging on those different geographies where we are present. We are also having initiatives for improving the level of customer service. One of the reasons of complaints that we have is because of the POSs and the ATM that keep having downtime. So we're renovating those. We're changing those POSs and ATMs, which will help in improving customer service. We are looking also at the business processes at the branches and taking away as much load as we can out of the branch and centralizing so that we can have proper higher level of customer service at the branches. Segment B will continue to be a part of our strategy, despite this one-off accident that we have, one-off incident. We have a sizable business in segment B, and this unfortunate incident that happened is a major wake-up call for us. So we've been looking at all the operational weaknesses, and we are addressing one by one and putting checks and balances everywhere where required. We had a relook. We're having a relook at the portfolio and doing a cleanup. So we want to build up a good segment B business by leveraging our presence by leveraging on the presence country that we have. What I think Andrew also mentioned earlier, it's quite comforting to see that our foreign currency deposit from segment B continues to grow despite everything. So that's on the general on the banking side. So I'll invite Chris to speak on the non-banking side.
Good afternoon, everybody. From the non-banking side, we have a very strong stockbroking business. We have a good asset management arm where we have assets under management of close to $300 million. And we have a registry and paying agents business as back office to support these front office operations. We have last year been awarded an investment banking license. We were the first institution to be granted an investment banking license following the introduction of the new legislation. And we are now in the process of centralizing some of the operations under that one license, where we will be having the stockbroking business, the asset management side, plus the capital raise and transaction advisory activities. On the transaction advisory side, we were engaged by Afrexim last year for their DR raising, where we mobilized $166 million. Earlier in the year, we have been busy raising the Tier 2 bonds for SBM Holding, which were both rupee and dollars were oversubscribed by 50%. We have a number of pipelines for external clients on which we are working for both debt and capital raising. We have also recently launched a factoring operation, which is slowly gathering momentum and which should be in full-fledged operation during the second half year. Another area where we are very active is in insurance agency, where we are offering bank assurance services to our clients. And whilst this was originally meant for our banking clients only, we are gradually extending this to non-banking clients and using this facility to convert the non-banking clients into banking clients to increase our range of services and penetration of the market. That's in a nutshell for the non-banking financial cluster.
Thank you very much, Chris. Super. Thank you, Raj. So we move on to other countries, and look, we fully recognise that our domestic franchise is fantastic and is the heart of our business. But we do think for the future we need that reach into Asia and that reach into Africa that India and Kenya give us, which is why we are doing much of what we're doing. So we were the first the first foreign bank in India to be awarded a wholly owned subsidiary license. We're now just waiting final approval from the RBI to start that transition process, which is all planned out. The intention is to exploit the linkages, as Raj referred to, between our countries of operation to grow both the funded and non-funded business, but to do both ends of a transaction, to enable us to do things that certain other banks actually can't do as a consequence. And there's been a great example in the last 10 days of Treasury here in Mauritius undertaking a transfer for a client on a same-day basis through to India that actually none of our competitors here in Mauritius could do. doesn't sound like much, but it's the validation of this isn't about huge lending. This is about enabling clients to do things otherwise they couldn't do. We are looking to grow our presence and capability in India based upon our customer value proposition, but that is not about physically opening more sites in the near term. What we're interested in the near term is moving from a business that over a long life cycle as a series of branches hasn't really created value, to driving a broader retail client base, driving a broader retail deposit base, and building a sounder business. And then we recognize we have quite a stock of impaired assets in India. We'll be looking to continue to manage those and seek recovery of them. We will not be neglecting them. In Kenya, I think you're all aware of the takeover of certain of the assets and liabilities of Chase Bank Limited in receivership. That work is underway at the moment. We go live on the 20th of August in terms of Monday morning, opening those new branches under the SBM branding to the clients of Chase and SBM Kenya. So we have a changeover on the 18th of August, which is Saturday. Chase branches are closed for the weekend, and I'll be doing a soft launch with teams on Friday. Our focus on that new combined business, which will comprise over 60 branches and over 700 people, is about stabilization and integration. We have not yet integrated systems. We will be doing that over a period of the months to come. It is about making sure that clients of former Chase Bank, clients from former SBM Kenya get a great service from us, and that we control the bank well. So aligning that institution to group policies, particularly in terms of risk and compliance, is really important to us. We will come on to enablers and what that means in a minute. In Madagascar, we've opened our 5th branch, and in Seychelles, we've had a license for a while. We're now operationalizing that and intend to be open for business at the end of this year, stroke the start of next year. So that's all very well geographically. How do we achieve that? Well, we need to continue to improve capability. That's about training our people. It's also about recruiting people. And it's about improving the culture of the organization. Now, the culture of the organization, and I've been here 6 months, is a very friendly one. It's very inclusive. I want it to be more constructively confrontational, because I think that will help us make better decisions, and I think that's an environment where it enables people to grow and take new challenges as well. And the key word is obviously constructively confrontational. In terms of technology, you all know that we have invested heavily in technology over the last 6-7 years. You've seen that come through in the cost line now. The challenge is that we're starting to get the data and data flows that enable us to drive cleverer behavior. But we need to manage IT costs very hard, and we need to manage the costs of change hard to make sure that those not only remain under control, but where we can, we should be seeking to reduce that. IT costs as a proportion of income are too high, in my personal opinion. And then we need to revamp the group organization and governance structures to make sure that there's clearer accountability and real clarity as to who does what. So the last slide that I talked to is the key enablers slide about risk management. And this is really important to us because, as Raj says, what's happened in segment B is a big shock to us. It is a huge wake-up call. It's a suspected fraud relating to a segment B client. So we do see it as a one-off event. But, and this is a really important but, it has made us think very carefully about what we do and how we do it. It's made us start a number of pieces of work about what is an appropriate size of exposure to take in a country outside our domestic franchises. It has made us think about aligning our country risk strategy much more closely to our risk appetite. And it's made us put in place a number of interim measures to ensure that we do not get another example coming into the fold. So specifically, as we have a clear strategy around these countries, about Asia, Africa corridor, about Kenya, India, Mauritius, Madagascar, Seychelles, and the flows between them, we're looking to much more tightly align the country risk appetite to that strategy, and indeed the risk appetite overall, so that we are banking clients of our business in other jurisdictions, so that we're doing both ends of the transaction. And so we're only doing business in countries where we wish to do business. We're not going to be opportunistic about it. We want to improve the risk culture and make people more risk aware rather than risk averse. I realize for some of you that will probably sound like a bit of a trite phrase, but it is really important for our people to understand the risks inherent within the different types of business we do, and then to be able to manage them properly. And I expect that will mean that we will need to strengthen our risk capabilities by training our people and also by recruiting some people. I've talked about the country risk framework. Raj and I, in conjunction with others, will be undertaking an end-to-end credit process review. I think the process needs some changes going forward, and this is not credit approval. This is from preparation to validation to sanction to terms and conditions to disbursement to monitoring to getting your money back. And I previously spent a lot of my life doing both credit and risk, and I will be looking for someone to help me do that piece of work, but will not be hiring a firm of consultants to do it, because it's something where we want to get some practical changes implemented relatively quickly. And that obviously leads to the last point, which is about revamping the risk organization structure, which follows the end-to-end process review. So I think I'll stop at that point and open it up for questions, Shailen, if that's okay.
Yes.
I realise I rushed through that a bit, but I thought it was important to have the time for questions rather than anything else.
Yes, of course. Thank you, Andrew. Thank you, Raj. We've got some questions that have come in. We've got a few questions from Ashmore. They are not on the call, but they have sent the questions for the replay of the call.
Okay.
The first three questions relate to the suspected fraud, so I'll read the three of them together. First one is, how was the supposedly fraudulent loan initially missed by the bank, and what has the regulator said in response to this development? The second is the investigation relating to the supposedly fraudulent loan specific to the loan only and not extending to all segment B loans lent in a specific market over a period of time? And the third one is, has the loan been fully provisioned and written off? When do you expect to conclude the investigation?
Raj, do you want to?
Raj?
Okay, let me take this question. How was the supposedly fraudulent loan initially missed by the bank, and what had the regulator said in response to this development? We never missed the fraudulent loan. The loan was regular in our books until sometime in end of July, when we tried to contact the main person behind the company or the borrower, the person had absconded, and this is where we declared it as a suspected fraud, and we have reported it to the regulator. The regulator will be carrying an independent examination, but the report is yet to be issued. So we never missed it. As soon as we discovered the fraud, we reported it directly to the regulator, and we also chose to provide it fully. The question number 3 is, has the loan been fully provided? Yes, fully provided, written off, not yet. And when do you expect to conclude the investigation? The investigation by the central bank is ongoing. On our side, we have already lodged a police complaint for criminal action against the borrowers. We also have initiated civil actions against the borrowers in Dubai in the IFC. And these are ongoing processes. We have also initiated proceedings with our insurance company also for recovery under the insurance policy. So all these actions are ongoing. Interpol is also on the lookout for the main borrower. So all these actions are ongoing for the time being. Yeah.
And there's also the question on whether that extends to all segment B loans.
So we've done two examples. One is that the investigation is going by Centrum and internally on that specific case. But beyond that, we also relooking, as I said, at the segment B book, and we're looking at each and every file, seeing that everything is covered, and if there is any loophole or any checks and balances to be implemented, we are doing that. That's an ongoing process, and probably Andrew will touch on that later. So we expect, if you want, we expect to complete that exercise in a couple of months. But that's ongoing, and we're putting the checks and balances as and when we're progressing on that.
Yeah, look, as Raj says, we've put in place some controls about, 3 months ago regarding new clients, because we wanted to decrease the size of individual exposures going forwards, and also started to narrow the range of countries then. This event has convinced us that was the right thing to do. Unfortunately, onboarding this client significantly predates that event. We do think we have the right controls around new clients, new countries, existing countries, country limits, size of deals now, which is really good. What we're doing is a review of all collateral to make sure that it's appropriate, review that we will initiate of the process to make sure that is tighter, review of all the appropriate second line checks in the process to make sure that they validate terms of approval, that disbursement happens against the right documentation, that the monitoring is effective and done in a timely fashion, and that we get our money back. So that work is underway, and that will give us a much stronger risk management capability going forward.
Thank you. The next question is, any guidance on cost of risk on a normalized basis this year and 2019?
I think that's a really difficult one at the moment. I mean, do we expect recurrences of this event? No. Did we expect anything out of line in terms of Mauritius with what we'd had before? Not really. I think we just need to finish the work that validates where we are in terms of the controls.
Yeah. And then the last question from Ashmo was, do you expect to consolidate Kenya by third quarter of 2018 or fourth quarter of 2018?
Well, this is consolidate as in open or consolidating financially?
I think Kenya is already consolidated in the books.
SBM Kenya is, but the Chase assets are not.
So,
And we would expect those to come in. So Ram, help me here, with effect from the end of August or 20th of August? Or?
Yeah, 20th of August it will come into our books. So for quarter 3 it will get consolidated. However, the entire issue around goodwill, etc. will get frozen by the end of the financial year. So 31st December would be the complete consolidated picture.
Now, in terms of business integration, because it may refer to that as well, obviously we open on Monday the 20th as one bank. There will not be systems integration by then. That is a process that will continue through to the end of quarter 4 before completion. We're not prepared to risk rushing systems integration for obvious reasons. But in terms of policies, processes, we expect that to be completed during Q3. I think that deals with Kenya in both senses of consolidation.
thanks. Those were the questions from Ashmo. We also have a few questions from Rahul of Exotic. So I'll read them out. The first one is, in addition to the 932 million food provision, it appears that SBMH has taken some other one-off provisions. Could you advise whether this is the case and provide some details on this?
Yes, this is absolutely the case. As I said earlier in the presentation, there are 3 causes of the provisions apart from business as usual. There's the segment B client that we've talked about. Well, the suspected fraud related to the segment B client. So getting the wording right. There is a an impairment related to IFRS charges passing through, and then we've taken a further impairment on our business in Kenya. So this is not the Chase business. This is the SBM Kenya business that we bought last year, the former Fidelity Commercial Bank, on review this year as to the quality and nature of that book, we felt that it was appropriate to provision that more heavily. We've taken provisions of two types: those that we think are appropriate on an ongoing basis and those that we think catch us up with what is appropriate. So if you were to say what's one-off as opposed to ongoing, I'd say the one-off related to the segment B suspected fraud, which is 930 million. You'd have 140, 150 million relating to the kind of Kenya catch-up to get us to where we want to be. And that gives you the underlying. We've also taken some management actions in Kenya in terms of outsourcing retail and SME recoveries to collection agencies, which previously hadn't happened. And we are in the process of recruiting workout capability for our corporate portfolio in Kenya, which I think will start to slow the rate of impairment of the legacy book in Kenya. Hopefully quite rapidly, but certainly start to slow it. I expect the Chase book to be of materially better quality. We have had due diligence done on it by a firm of consultants for us last year. We've done a round of due diligence last year. We did another round earlier this year and excluded further assets. And the team in Kenya, together with some support from Mauritius, are finalising a line-by-line review of the residual book that we're looking to take on at the moment. So I think that takes the right actions with regards to Kenya and hopefully gives you the clarity as to what's legacy as opposed to ongoing.
Yeah, I think you covered the next question as well, which is to what extent is the drop in impaired advances due to write-offs, and to what extent does it reflect recoveries?
So this more refers, I think, to the Mauritian book.
Yeah.
Raj, do you want to comment?
Yeah. I think if you look at the figures between June 17 and June 18, the gross impaired advances have been more or less flat, 6.7 to 6.6. So we had a write-off exercise done in December of roughly 1 billion rupees, if I remember well. And then so if that billion rupees bring down 6.7 to let's say 1.2 approximately it was, so bring down to 5.5. And then this half year we took an impairment of 1.1 billion, which includes the NPA, the impaired segment B, and the IFRS 9 provisioning. So that's come to 1.1 billion. So roughly that reconciles the figures. So whatever we kind of wrote off in December, we had to book again in June.
Okay, the next question is what steps have been taken to ensure risk controls and corporate governance will be better in the future? I think you covered that already.
Yeah, let me just be absolutely clear about this though. So there was some adverse press about SBM Holdings, SBM Group about 3 months ago, predominantly in the Mauritian press, but also in the Kenyan press, regarding facilities provided, according to the press, to 2 Kenyan groups that were risky and unsecured. Issued a cautionary statement to advise that not everything in the press was accurate, but obviously we took some steps to improve our position with regards to those exposures at that stage. And we believe those are fine. However, at that time, this is going back a few months, and I referred to this earlier, we put in place much tighter limits about what business could be done without referring to a higher level of authority. We said anything that's in a non-presence country must be escalated to a higher sanctioning body than would otherwise be the case. We introduced lower limits for any exposure to any group of clients. We introduced a lower limit before structures would be referred up to group for appropriateness. We revised the country risk approach to ensure that we aren't doing business in countries where we don't either have a presence or wish to do business, and that's a very limited list. We introduced a higher level of integrity due diligence checking, and we improved our compliance processes and thresholds. So we took a huge number of measures 3 months ago. Those are good. They give me real comfort about the flow. The work we referred to earlier regarding the review of collateral, structures, and disbursement controls will give us the evidence regarding the existing portfolio. Sorry, I just think that's probably what our shareholders want to know about. So.
Sure. The next one is, given the bank's low profitability and regional expansion plans, it is likely that the Tier 1 ratio will continue to decline. What floor level for the Tier 1 ratio is management happy with?
Well, I think this is an interesting one because I don't think the profitability is that low if you exclude the one-offs here, and I expect that to improve as Kenya starts to turn and as India continues to improve. I mean, India has been a drag, I think, for a period of time and is now neutral. I expect Kenya to move from being a drag to being neutral to being positive as well. Our move into the Seychelles is a low-cost move, and indeed I have previously opened a bank in the Seychelles that was profitable within 9 months, so I'm not sure we will do that, but I see it as a short-term profitability country rather than a long-term profitability country. So I don't see the low profitability continuing, and if you look at the figures for SBM Mauritius, I think they are pretty good pre-impairment. Now, I realise you can't spend pre-impairment profit, you can only spend post-impairment, so that is why we need to make sure our controls are right, etc. That's a long-winded answer to that part. With regards to the Tier 1 ratio, the Board of Directors will determine what we are happy with. I personally think that 17 to 19 is a good range. If we were to go marginally below that, I wouldn't be concerned. If I were to see a continual decline, I would be concerned. And if you look at the figures for Tier 1, so not aggregate capital, but Tier 1 in the presentation that we've sent out, you'll see that's broadly flat around the 19% range. So let me just find it again. And it was 18.77 2 years ago, 19.26, 18.97. So I think we're in the right range. If I were running a developed markets bank or a broader, more diversified bank, I would start to worry about being overcapitalized. I think that's just cautious and sensible for us.
Thank you, Andy. So these were the questions from Rahul. Thank you, Rahul, for these questions. We have one question also from Natalia of Duet. So the question is, could I to comment on the sharp increase of effective tax rate for reported first half 2018 period, as well as to give more details on elevated provision charge related to suspicion in fraud?
I think we've done the second part of that, which is the provision charge. So, I mean, as Raj said, it's a suspected fraud related to a segment B client on which we have taken 100% provision. So there is nothing more to come on that. As Raj said, there may be something on insurance, there may be something on recovery. He's started criminal proceedings, he's started civil proceedings, he's lodged notice with the insurance agency. We don't know what will come out of all those, but he has prudently taken 100% up front. I'm not a tax expert, and I'm looking desperately around the table trying to find one. I think we've nominated Ram as
Sorry, what was the question?
The question is, we've got a sharp increase in the effective tax rate. So the tax rate's going up despite the impairment charge. And you and I talked about this the other day.
Yeah. So basically, because the way the tax liability is calculated is that the provision amount is not allowed as a tax deductible. So it is added back to the income and the tax liability is calculated accordingly, because, mind you, the overall operating profit before the provisioning has actually gone up. So therefore, the tax liability has increased, because the rules over here is the provisions needs to be written off, or there has to be a court ruling against on those debts. Only then they can be claimed as a tax write-off. So which is why the tax liability is being calculated accordingly.
Okay. So thank you, Natalia, for that question. Kumal signals me that there are no more questions on his mails. So I'd ask if anyone from the call, if you have any follow-up questions or any new questions that you want to ask, please identify yourself and raise point. So we don't have any more questions. Any comments from the team here?
One thing I would say is that I'd like to thank those of you who joined us and who are listening to this on recall for making the time. If you do have follow-up questions or you have any other issues that you want to talk about or raise, please do write to Kamal. You will have his details. Please also send him the details of who in your organization should be on his list to write out to as well, so that we have a full register of people to invite to calls like this. I want them to be a regular feature, but not focused around impairment, but a regular feature around the progress on our strategy, which is really important. And I think where we're coming from is we want to improve our investor relations capability. That's why Kamal is on board with us. So please help us do that. Tell us what would be useful for you. And thank you.
Thank you very much, and have a nice day.